You see the headlines every day. Billionaires are buying up gold, Bitcoin, and luxury real estate. The financial media is obsessed with it. They dedicate entire segments to it. Portfolio managers go on television to debate whether gold will hit $5,000 an ounce. Crypto influencers scream about the next rally. Real estate agents showcase mansions in Miami and Manhattan, penthouses with infinity pools and helicopter pads. And while everyday investors are chasing these popular assets, reading the same articles, watching the same talking heads, following the same Twitter accounts, the ultra-wealthy have already moved on. They're quietly accumulating 3 obscure assets you've likely never heard of. These are assets so essential, so fundamental to human survival, they could become more valuable than gold when the system finally breaks. And they're doing it in total silence. No press releases, no flashy interviews, no mentions in the Wall Street Journal or Bloomberg. Just a systematic accumulation through shell companies and private transactions. LLCs with names you wouldn't recognize, buried in Delaware or Wyoming corporate registries. Trusts hidden behind layers of paperwork. Deals that close without a single public record, without a headline, without anyone noticing. This is the quiet revolution in wealth, and today we're pulling back the curtain. First up, asset number 1. Farmland, but with very specific characteristics. You might know Bill Gates as the co-founder of Microsoft, the man who built the personal computer revolution. But did you know he's also America's largest private owner of farmland? He owns a staggering 275,000 acres spread across 18 states. That's an area larger than the entire city of Los Angeles. Bigger than all 5 boroughs of New York City combined. Bigger than the entire nation of Singapore. And he's been buying it up since 2013, year after year, purchase after purchase, systematically building this empire. But this isn't just any random dirt. There's a clear pattern. When you map out his holdings, when you look at soil surveys and water tables and climate data, something remarkable emerges. In Louisiana, he owns nearly 70,000 acres in the Mississippi River Delta, home to some of the richest topsoil on Earth. This is land that's been enriched by river sediment for thousands of years. Layer upon layer of nutrients deposited by annual floods. It has almost unlimited water access and one of the longest growing seasons in the continental United States. You can plant multiple crops on this land in a single year. Corn in spring, soybeans in summer, winter wheat in fall. In Arkansas, another 48,000 acres in the heart of rice and soybean country, with prime access to the Arkansas River and its tributaries. This isn't marginal land on rocky hillsides. This is the kind of farmland that produces reliable yields even in drought years, the kind farmers dream about owning. In Nebraska, his land sits directly above the deepest sections of the Ogallala Aquifer, the massive underground reservoir that stretches from South Dakota to Texas, guaranteeing irrigation for 100 years, maybe more. Wells drilled here tap into water that's been underground for 10,000 years. The story is the same in Washington and Florida. Land with access to the Columbia River Basin or major aquifers like the Floridan Aquifer. Every single purchase has one thing in common: water. Guaranteed, long-term, legally protected water. Just last year, he spent over $131 million on just 8,000 acres in Washington state. That's $16,000 per acre. 4 times the national average for farmland. Higher even than prime Iowa cornland. Why would anyone pay that much? Why spend 4 times what the market says land is worth? Because it came with installed irrigation systems, tens of millions of dollars worth of equipment already in the ground, aquifer access through dozens of permitted wells, and most importantly, the water rights. The legal permission to use that water forever, in perpetuity, no matter what happens to the surrounding region. That's what he was really buying. The land was almost incidental. The pattern is undeniable. Gates isn't just buying land. He's buying 3 things that can't be replicated, 3 things you cannot manufacture or create. 1. Superior soil, the kind that takes millennia to build, the kind that forms at the rate of 1 inch per 500 years. 2. Guaranteed, long-term access to water, locked in through legal rights that predate most modern cities. And 3. A climate that supports multiple growing seasons a year, maximizing output and flexibility. He's not necessarily trying to be a farmer today. He's not out there driving a tractor or checking rainfall levels or worrying about commodity prices. He is positioning himself to control the future of food production for when global supply chains inevitably face disruption. When shipping routes fail, when trade agreements collapse, when nations start hoarding grain exports to feed their own populations. When climate change makes farming impossible in regions that have grown food for centuries, the people who own the land and the water will write their own rules. They'll decide who eats and who doesn't. This brings us to the second, even more critical asset, water rights, which are often completely separate from the land itself. Most people don't understand this. They think if you own property, you own everything on it and under it. The trees, the minerals, the water. Not true. In the western United States, you can own 1,000 acres of land but have zero legal right to use the water that flows through it or sits beneath it in underground aquifers. The system is called prior appropriation, which basically means first in time, first in right. It's a system that dates back to the gold rush when miners needed to establish clear water rights for their operations. Those who hold the oldest, most senior rights that might date back to the 1800s, get their full water allocation first during a drought, while everyone else gets what's left, if anything. Junior rights holders, those whose rights were established later, can be completely shut off. Their irrigation stops. Their crops die in the fields while senior rights holders water their alfalfa or fill their swimming pools. And these rights can be bought, sold, and transferred, just like any other asset. They're detachable from the land. You can sell the water rights and keep the land, or sell the land and keep the water rights. They're separate property. Decades ago, oil tycoon T. Boone Pickens saw this coming. He understood that water would be the oil of the 21st century. In the 90s, he started buying up land over the Texas Panhandle's Ogallala Aquifer. He wasn't after the land. He wasn't interested in farming or ranching or building anything. He was assembling the rights to extract 65 billion gallons of water per year. That's enough to supply a city of 1 million people. Enough to fill 98,000 Olympic-sized swimming pools. Enough to keep Las Vegas running for 6 months. In 2011, he sold a portion of those rights, not the land, not the water itself, just the legal right to pump it, to a group of 11 Texas cities desperate for reliable water supplies for $103 million. His remaining water rights are valued at over $500 million today. He turned dirt-cheap ranchland that cost him maybe $500 an acre into a water fortune worth thousands per acre. Now Wall Street has entered the game. Investment firms are scouring the West for opportunities. A firm called Water Asset Management bought 2,500 acres of farmland along the Colorado River in Arizona. The land itself was worth maybe $50 million. Decent farmland, nothing special. The senior water rights attached to it? Worth $300 million, 6 times the value of the dirt. Their strategy is simple but ruthless. Buy farmland with old untouchable water rights that date back a century. Help the farms become more efficient with drip irrigation and precision agriculture that uses half the water, and then sell the saved water to desperate growing cities at a massive profit. It's water arbitrage and it's completely legal. Cities like Phoenix and Las Vegas are desperate. Their populations are exploding while their water supplies shrink. Phoenix added 2 million people in 20 years. They'll pay almost anything for guaranteed water. Then there's the incredible story of the Resnick family, owners of the Wonderful Company. You know them. They sell wonderful pistachios, Palm Wonderful Juice, Fiji water, Halos mandarins. In 1994, through a complex series of legal maneuvers that critics still call suspicious, they managed to gain control of the Kern Water Bank, California's largest underground water storage facility. This massive reservoir, which can hold 500 billion gallons, roughly 10% of California's annual water usage, was built with taxpayer money, a public infrastructure project designed to help the entire region. But now, a private family effectively controls who gets that water and what price they pay. During droughts, they can pump water out and sell it to the highest bidder. They've made billions by controlling access to a publicly funded resource. During California's worst droughts, while farmers went bankrupt and towns ran dry, the Resnicks kept their vast pistachio and citrus groves green and sold water at premium prices. Politicians have investigated. Lawsuits have been filed. Nothing has changed. The legal structure is too solid. Even the Mormon Church is making moves. The Church of Jesus Christ of Latter-day Saints, one of the wealthiest religious organizations on earth, saw the opportunity. In 2021, they spent $200 million to buy 22,500 acres in Washington state. outbidding Bill Gates himself in a fierce auction that went back and forth for weeks.
The prize?
Not the land, but the senior water rights on the Columbia River system, one of the most reliable water sources in North America, a guaranteed water supply forever. The church owns vast agricultural holdings across the West, farms and ranches that generate enormous revenue, and water is the bottleneck to expansion. With these rights, they can grow food indefinitely. Why is this happening now? Why the sudden urgency? The data is alarming. The Colorado River's flow has decreased by 20% over the last century, and the decline is accelerating. Lake Mead, the massive reservoir that supplies Las Vegas and much of Southern California, sits at historic lows, barely 30% of capacity. You can see the white bathtub ring on the canyon walls, where the water used to be hundreds of feet above the current water line. The Ogallala Aquifer, which provides water to 8 states and 30% of America's irrigation, is being pumped out far faster than it can naturally recharge. In some areas of Kansas and Texas, it's dropped by over 100 feet. Wells that worked for 50 years are now dry. The snowpack in the Rocky Mountains, which feeds these river systems through spring and summer runoff, is declining. Scientists project it could drop by another 30% by 2050. Less snow means less spring runoff, which means less water in the rivers. The water supply in the West is shrinking while the population, and therefore the demand, keeps growing relentlessly. California's population has doubled since 1970. Arizona's has quadrupled. Nevada's has increased sevenfold. The math doesn't work. The supply can't meet the demand. Mark my words. In the year 2030, the people who control water rights will be wealthier than the people who own oil. You can live without oil. You can switch to electric cars, install solar panels, ride a bike, take the bus. You cannot live without water. There is no substitute. There is no alternative. No technology can replace it. 3 days without it and you're dead. Every civilization in history that ran out of water collapsed. The Mayans, the Mesopotamians, the Anasazi. They built great cities and they disappeared when the water ran out. We're not different. Finally, we arrive at the third surprising asset of the ultra-rich. Catastrophe bonds, or cat bonds. This is one of the most unusual but brilliant investments you'll ever hear about. Most people have never even heard the term. Insurance companies create these bonds to transfer the massive financial risk of a major disaster, like a Category 5 hurricane or a magnitude 8 earthquake, to investors willing to bet against catastrophe. It's a way for insurers to offload the risk of a truly catastrophic event that could bankrupt them overnight. Here's how it works. An insurer, let's say a company that covers properties in Florida, issues, say, $500 million in cat bonds to protect against hurricane losses. Investors buy them up, often in blocks of $10 or $20 million. That money is then held safely in a collateral account, usually invested in U.S. Treasury bills, so it's protected and earning a baseline return. In return for taking on the risk, the insurance company pays the investors a very high premium, often between 9 and 14% annually, sometimes even higher for extreme risks. For comparison, a standard Treasury bill might pay you 4%. A solid corporate bond might pay 6%. But cat bonds pay double or triple that because you're taking on real, physical risk. If no major specified disaster happens during the bond's term, usually 3 to 5 years, the investors get their original principal back plus all those juicy premium payments. It's an incredible return, better than almost any traditional fixed income investment. But, and this is the catch, if a hurricane or earthquake hits that's strong enough to trigger the bond's conditions. If it exceeds a certain wind speed or magnitude, if it causes a specific dollar amount of damage in a defined geographic area, the investors can lose their entire principal. That money then goes to the insurance company to help pay out claims to homeowners and businesses whose properties were destroyed. It sounds risky, and it absolutely is. You could lose everything, but look at the actual returns. In 2024, the average return on cat bonds was over 17% compared to the S&P 500's 7%. That's more than double the stock market with less volatility. In 2023, they returned nearly 20% while the stock market struggled. Even during a market crash, they perform. When the S&P 500 fell 15% during the pandemic panic of March 2020, when portfolios everywhere collapsed, cat bonds were actually up 1%. Why? Because their performance is completely uncorrelated with the economy. Tariffs don't cause hurricanes. Trade wars don't trigger earthquakes. A recession doesn't make a wildfire more likely. Interest rate changes don't affect tornado frequency. Their value is tied to physical events, acts of nature, not economic cycles or market sentiment or Federal Reserve policy. That's diversification in its purest form. True portfolio protection. This market is exploding. It's grown by 50% in just the last 5 years, with over $50 billion in bonds now outstanding. A decade ago, the market was barely $20 billion. It could hit $100 billion by 2030. Who's buying them? Specialized investment funds that focus exclusively on insurance-linked securities and have teams of meteorologists and seismologists on staff. Massive pension funds from California to Canada looking for uncorrelated returns to balance their stock and bond holdings. Major hedge funds that want exposure outside traditional markets. And even giants like BlackRock and PIMCO, the biggest asset managers on the planet with trillions under management, are getting involved. They're dedicating entire teams to analyzing catastrophe risk. The boom is driven by two main factors. First, climate change is unfortunately increasing the frequency and severity of natural disasters. The data is undeniable. Hurricanes are stronger, with more Category 4 and 5 storms in the last 2 decades than the previous 50 years. Wildfires are larger and more destructive, burning millions of acres annually. Floods are more common as rainfall patterns shift and intensify. That means insurers need more protection, which means they're willing to pay higher premiums to offload risk to investors. Second, as insurance premiums rise to cover these risks, as homeowners in Florida and California see their rates double or triple, the yields offered on cat bonds become even more attractive to investors. It's a cycle that feeds itself. Higher risk means higher premiums means higher returns. In a year like 2022, when both stocks and traditional bonds went down, when a classic 60/40 portfolio got hammered and lost 15%, cat bonds were one of the few assets that went up, providing true diversification. They don't move with the stock market. They don't move with interest rates or inflation. They move with nature, with physical events that have nothing to do with human economics. So there you have it. While the world is distracted by gold and crypto, while financial television debates the next Bitcoin cycle and whether Ethereum will hit $10,000, while real estate agents showcase penthouses and luxury condos, the smartest money is quietly securing control over the very building blocks of civilization, the land that grows our food, the water we need to survive, and even the financial instruments that protect against global chaos. These aren't speculative plays. They're not hoping for a greater fool to come along and pay more. They're not betting on sentiment or hype or the next trend. This isn't just about getting rich. It's about securing a permanent and unshakable form of wealth. It's about owning the things that will matter when everything else fails, when currencies collapse, when governments fall, when supply chains break down completely. Water, food, and protection from chaos. The 3 pillars of survival. Thanks for watching. If you found this insightful, make sure to like and subscribe for more deep dives into the world of finance.